Welcome back to the Group Practice Accelerator podcast, brought to you by Polaris Healthcare Partners, where we leverage decades of healthcare and business experience to drive growth in successful group practices just like yours. If you're a healthcare entrepreneur and you're interested in building, scaling, or exiting your group practice, you've found not only the industry's leading resource for business education, but a team of trusted advisors dedicated to helping you achieve and exceed your goals. In short, the team at Polaris creates clarity, confidence, and results. I'm your host, Jamie Falash, and the Group Practice Accelerator podcast is on the air. Hey everyone, thanks for joining me today because we've got a lot to cover. But before I jump in, just a quick reminder that the American Academy of Orthodontics AAO annual meeting in Philly is coming up soon. And that runs from April 24th through the 27th. It's a worthwhile show for sure. And most importantly, you'll want to register for our free pre-conference workshop and cocktail hour that takes place on Thursday, the 24th from 4:30 to 6:30. The workshop's going to be held at the Convention Center in room 201B. And as you might recall from the last few episodes, I mentioned that the workshop is intended to be interactive. So a lot of Q&A, a lot of conversation, and it's designed to provide you with actionable insights on how to get the highest value from your business. So that's whether you're looking to drive growth, whether you're looking to think about an exit, either way. And did I mention it's free and there'll be cocktails? I think I did. But in either case, you'll leave with the right resources to fuel those decisions. So don't miss out. To reserve your seat, please register by visiting polarishealthcarepartners.com/AO. All right, on to today's topic. So among the top things we're asked about by our listeners is, when is the best time to go to market? Well, that's a question that begs a more in-depth answer because everyone's vision and businesses are different. But when we take a closer look, we can start to answer that in a couple of ways. First, market conditions aligning with your vision and plan make it a great time to sell. So yes, maybe now's that time. That's really oversimplified, of course, but we'll expand a bit on that later. Second, preparation and optimization. What's your EBITDA-based valuation, and does it reflect an ideal position for both you and buyers? If you're in that sweet spot that buyers look for, then absolutely. Again, it's time. Now, a lot of layers to uncover when we get to this question, and here to deconstruct what you need to think about as you move toward a sale in 2025 is our founder and CEO, Diwakar Sinha. Diwakar, welcome back to the podcast.
Jamie, thank you for having me.
Well, pleasure to see you again. Great to have you back. So, hey, I know our listeners are trying to stay on top of the market. And if they've been considering a sale, a lot has changed in the last couple of years. So I know they're thinking about that. So when they ask, when is the best time to sell? That answer has a lot of moving parts. I know you and I have talked about this at length. So I want to hit you with a multi-part question right out of the gate. Can you help our listeners understand why 2025 is the time, and understanding that some deals defaulted or just didn't go through in 2023, 2024. And I know we're past that in the market, but tell us why and maybe talk through that course correction.
Sure. Yeah. So I think, just to kind of go back a little bit history in time, 2023, 2024, it was a good time if you had the right deal on market to go to market, right? So 23 and 23, good deals did transact. 2024 deals did transact. If you guys are following our, announcements in the market, our podcasts, we had a transaction at almost 10x, that transacted in the market in 2024. So yes, deals were happening in those last 24 months. That said, diligence was a meaningful aspect of how deals were being looked at. There's less deals in market going to market, and buyers were a little more cautious of how they looked at deals in the market. So you had to have the right deal when you were going to market in 2023 and 2024. On a macro industry standpoint, there's a lot of deals that had failed processes in 2023 and 2024. Going back to 2023 specifically, what may or may not have been talked in the market is cost of capital is extremely high. We put it on our podcast in the past, even in 2024, cost of capital is extremely high. SOFR was high, LIBOR was high. Obviously, if you look at the consumer indexes, prime was high. And that resulted in a lot of the larger DSOs having challenges, pricing compressions, and defaults. We may or may not have heard those things downstream. but there were some defaults happening from lender issues in the portfolio. You see some bigger DSOs laying off M&A teams, making some cutbacks in the operational teams, things like that. And we still see some of those repercussions coming out into Q4, into Q1, from those decisions in 2024 to 2025. That said, I think we're on the back end of those decision points in that process. So, going into 2025, is this the year to go to market? Right? I think I'm going to answer that question in multiple aspects of it. Staying consistent with the answers I've provided in our podcast in the past, the best time to go to market is when you're ready for a partner. And I think you have to want a partner to go to market. And we can help you identify, through our discovery day, go to market discovery day, sell side process to, figure out, is this the time to go to market for you? And what does that mean for you in your journey? So our go to market discovery day is different than our discovery day for if you're trying to build a group. And our build a group process, you come in, we do a personalized evaluation and kind of, build your process. If you're building a group from like 2 locations, 3 locations, 15, 25 locations, what does that look like for you? And what does that journey look like? In a go-to-market discovery day, we do a personalized analysis evaluation and walk you through what a sell side process looks like over a 4 to 9 month process. And then what is the market expectations, the analysis, the diligence process, things like that. And what should you expect in the deal pre and post transaction? And so I would, if you're considering that, obviously engage us and kind of evaluate what those options are looking like. So, but as far as going to market in 2025 on a macro conditions point, there's a lot of dry powder coming back out of 2023, 2024. Cost of capital's gone down, SOFR's gone down. If you look at SOFR in 2024 to 2025, I believe it's roughly about 90 basis points lower from 2024 conditions. Not quoting exact dates as of today's podcast rates, but 90 basis points lower for SOFR conditions. The prime index is lower, just kind of going into capital market conditions. Yes, I mean, today in our macroeconomic conditions, we have tariff conditions that are impacting short-term market conditions and what that may look like. But I think if you follow all the economists in the market, they're focusing on overall 6 to 9 month horizon decisions. And we always recommend our clients to think long-term, 9 to 12 months over the horizon and start to make decisions that way. So overall, for most people in having conversations with us, we do believe, again, if you're ready to find the right partner, if you have 80% of the vision of your business and 90% of vision of your business, you feel good about the trajectory of your business, have a conversation with us. 2025 is a good year to start thinking about going to market and looking at, what Q3, Q4 looks like for you, and even going into Q1 of 2026. But it is a lot of dry powder coming out of the last 24 months going into this year.
Well, good. That certainly gives some welcome news. I want to shift back to something that you mentioned when you started to answer the question about 2023, 2024, and a deal that transacted at 10x. So my question is this: what about multiples during that time? Why did some deals transact at 10x or 6x and some just didn't transact at all?
So I think that one's just under 10x. Yeah, I think so. Multiple aspects. I mean, I think operational diligence coming out of, so let's go back to COVID years, so 2023 to 2021, 21 was a buying frenzy. I think everybody came out of it, and M&A 2021 was a really good year. Even 2022 was a good year for M&A. Then pricing conditions went up, and I think people started to look at some of the transactions they had done and some of the earn-out provisions and the APA agreements and the employment agreements and all those things that were done in the market. I think we're starting to be evaluated on a macro condition now. And I think if you guys have been following our podcast from Polaris from day one, we've been talking about those things and how Polaris structures these deals as far as how we look at holdco equity or JV equity, and how we've been coaching our clients to think about how to look at the deals, not just upfront on these deals, but back end of these deals and performance of those deals in the back end, and how that's meaningfully important for both sides. We want it to be a win, not just for our clients, but we want it to be a win for the back end of the purchasers. And the reason we want it to be a win for the back end of the purchasers is because we want the back end performance of the stock to be there, the rollover equity to be there, because most of our clients tend to roll over some level of equity into the JV or holdco equity. And, Jim, we can do another podcast, talk about different levels of equity about that. I don't want to get our audience members on that. So I think part of it is when diligence came out in 2024 is like, how do the deals get structured? What level of rollover equity is there? And that's going to determine some level of change in multiple. That's one. Two, I think too many people in the industry focus just as a common denominator of EBITDA. I go to conferences all over the US and people say, well, if I'm at 3 million in EBITDA, am I getting this multiple? If I'm at 2 million in EBITDA, am I getting this multiple? Am at 1 million, am I getting this multiple? And although there's some level of validity to that question, I think there's so many different issues that we need to consider to understand what is the multiple that you're getting and why are you getting that multiple. Right. I've seen transactions at $2 million in EBITDA trade for a higher multiple than at $3 million in EBITDA. So I think that's very important to understand. And I'll say that again for some of the audience members. I have seen deals at a $2 million in EBITDA transact at a higher multiple than deals at a $3 million in EBITDA. And so it's really important that when you have a conversation with us, you engage us for any process, you understand why that is and think through the diligence aspect of it and what you're really building and how we interview and how we coach you on the interviews and think about your business and what you're really building and what you're finding in a partner. And those are all things that are important and what your interview process looks like with the right partner, what your rollover equity looks like, where your equity sits. These are all the podcasts we've done. That's important because, again, I think I started earlier when you transact, finding the right partner is important. You have to be ready for the right partner. And I think all these small little decision points impact where your valuation ends up. And then also the kind of business you've built matters. When you engage us, we do a full, thorough analysis in your business to help you determine what are the operational and financial issues that will impact the value of your business. And from our analysis, is this business going to be, let's just say, this $2 million EBITDA business going to transact at a 6x, a 7x, or higher? And what would determine that? Is there a party that we've identified that's interested in that geography? And if they're interested in the geography, how would they look at structuring that deal in that market? And how would that impact the rollover equity at the JV level, at the holdco level? These are all the conversations we're having when you're engaging us, for your discovery day go-to-market. So there's a lot of rabbit holes we go into to help you understand the nuances of your journey. And again, sorry for the lengthy answer, but that's really how it goes from like 6x to a higher multiple, or even, again, we're using 6x as a denominator, but if somebody wanted to do a walkaway sale, nothing to say that the deal for that same $2-3 million in EBITDA could be not lower than 6x. In the market if somebody wanted to do a walkaway sale for different reasons.
Now that you actually answered another question that I had on deals that didn't get done and maximizing value, because we know that's a critical element, and how to address those during diligence, just to get ahead of it. But I want to shift gears for a minute. We hear a lot of talk and have seen a lot of activity in terms of consolidation. And a lot of people are wondering where we are in that track, if you will. Actually, you used the analogy of a baseball game recently, so I'm going to go with that. I know we're not at the top of the ninth. What inning are we in right now? And what about that timing makes it a good time to sell?
Yeah, so a lot of the conferences I've gone to, and these are conferences that are in our industry, that are regular DSO industries and just larger macro healthcare industry conferences. And they're going to say some will say conservatively or more optimistically, I would say they're more optimistic. We're only in our third inning. And some will say we're in our fifth inning. Our viewpoint is we're probably somewhere in our fourth inning, going into our fifth inning by the end of 2025 to 2026. So when we start looking at things from that lens and we kind of start to look at it from a baseball lens, we need to be thinking about, okay, when you're transacting, you have two bites at the apple. One is the first bite, one is the second bite. And not to say that deals cannot and will not transact in the seventh or eighth inning, but there's also the accordion aspect of the industry where the industry consolidates, slows down for a bit, and then expands again, and then consolidates again. We see that in the financial services industry, in the banking industry. We see that in the urgent care space where urgent hospitals consolidated with urgent cares back down. Now they're expanding again. You see in orthopedic space. You see it in traditional medicine, in different industries also. So our viewpoint is that we're in the fourth inning right now. So really, again, couple check marks for us in 2025. A lot of dry powder from 2023, 2024 coming into a very robust market condition in 2025. Could not emphasize that enough. Two, going into this, we're in our fourth inning, is our opinion, maybe the fifth inning, but really fourth inning. Going into the end of the year to early next year is probably the fifth inning. So a lot of great opportunity for established platforms, but also emerging platforms. Our definition of emerging platforms are platforms that are anywhere from 30 locations to 150 locations. These are companies that might have had one capital event, one turn in the industry, and if not, might not even have their first capital event in the industry, but they are private equity backed in the market. And then the established ones would be the bigger 800 to 1,500 location groups that are really good platforms that have had multiple turns in the market, and they have different return profiles, right? So great opportunity in the fourth inning to go in and transact. But you're also being cognizant about your second turn. And the second turn, depending on the partner you have and this life cycle you're participating in, and these are questions that we would go through in our diligence process, could be anywhere from a 3-year to 7-year profile based on the investment. It could be longer as 10-year. I mean, I always say 3 to 7, but could be as long as 10, because imagine if you had partnered with a company and then the capital conditions of 2023 or 2024 happen, you probably didn't have that transaction happen. So you're waiting till 25, 26 for those bigger deals to happen. Mm-hmm. So in this case, so if you're transacting on your deal in 25 and 26 in your fourth and fifth inning, your second bite is probably going to be in the sixth inning. And so you need to be cognizant of what that sixth inning is going to be and the second bite of the apple. And these are things that we want you to be cognizant of and as you're transacting with us. And we're conscious of, are you looking at that upstream company? Are you looking at the downstream company? What does the return profile look like for you? These are all questions we ask you in your discovery day with us when you're coming in, and we're going to create some performas and kind of give you that analysis in your process with us. So these are things to think about, but overall, fourth inning is where we think 2025 is, maybe fifth inning going into 2026.
Good. Great analogy. I like how you set that up. And sticking with consolidation for a minute, I know we've seen some bigger deals transacting over the past couple of years, but some also failed or took a lower valuation. Why was that?
Well, I think cost of capital in 2024 had something to do with it. But I think, overall, I think we've kind of, for the bigger deals, I think going back to 2016, going back to 2024, I just said we're in our fourth inning, right? So I think if you look at deals that transacted in 2011 to 2019, where some companies were getting 14 to 18 times multiple, I just don't think those multiples are there in the industry anymore. We're not in our second inning, our first inning of baseball, right? So I think just kind of staying consistent with that theme, we're, from our lens, our opinion, we're in our fourth inning. So we're just not going to see those multiples. So I think those bigger companies are probably around 12 to 14x in multiple, right? On the bigger platforms, maybe a little bit higher, at 12 to 14x. And I think that's where some of those companies transacted at last year. Some companies had expectations of going higher. Maybe the deal structures weren't there and coming out of their diligence discoveries in 2024, so they had failed processes. Not to say that the companies didn't have good value. They did have good value in the space. So I do want to echo that and reinforce that those companies that had failed processes in 2024 had good value. And they'll go back to market in 2025 and transact in Q1, Q2 2026. And what that's going to mean is like these bigger companies, that are 200 to 500 location companies will either have the next level of platform or more likely merge with another big platform and have a super platform. And what that means is these bigger platforms will slow down their acquisition process. Okay, so let's say a 500 location group may slow down their acquisition process going into end of 2025. And that just means there's a lot more opportunity for the emerging platforms to acquire. So I still think amazing opportunity for acquisitions if you're going to market. Just means that maybe if you were thinking, we would have gone to a 500 location group because of that profile. We will go to other locations, other groups that are 300 to 500 location groups that are still interested in that geography and still go look at emerging platforms. But there are going to be some groups that are consolidating in end of 2025 to middle of 2026 that are going to be consummating their transaction. They just have to recapitalize. They're at the end of their fund cycle or overdue in their fund cycle.
Okay. Makes sense. I was wondering what that would mean for downstream deals, but you answered that question for me. So, kind of in recap here, you mentioned something earlier on our call about discovery days. And I know I'm not new to the industry, but I've been with Polaris since last fall. And from what I'm seeing, it seems like a good chunk of our clients started by scheduling a discovery day. But I know you mentioned a couple of tracks that they can take there. Some spend the day with us when they're looking to decide next steps in growing their business. And, some might want to get prepared to sell. Can you talk in a little bit more detail about what a discovery day entails, how it's personalized for that one client? Because I know this is not a group event, and the difference between those two tracks in a little bit more detail so we can help our listeners.
Sure. Yeah. So we have two tracks. So we have a discovery day for clients that are looking to build their groups or evaluating to think about building their group. So that's our discovery day about, building your enterprise. So they come in, we evaluate their current platform and say, okay, you're at 5 locations, 2 locations, 10 locations. What have you built so far? What does your enterprise look like and where are you trying to head and why? And really over that one day, it's a personalized approach, understanding their partnership dynamics, if they're in a partnership, if they're 100% owner, what does their doctor profile look like, clinical profile look like, operational profile look like, and map out a 3 to 5 year journey for them and define what that would look like. And from that, the principals of that business kind of get to see what that journey looks like and see if they want that journey and what is the economic outcome, what their business goals look like and personal what work-life balance looks like. And really, it's a great day for them to kind of come out. And 50 to 60% of the clients say, I think when we're really good at our 5 locations or 10 locations, and the other 50, 60% say, we really are excited about that journey and we want to build that group together. And they move forward with that business plan coming out of that day. So that's a one day that either we come out to the client's facility or the clients come out to Charlotte for our discovery day.
Okay.
So that's building your enterprise. The other one is the sell side discovery day, which is where the clients engage us to help, again, personalized approach to evaluating their business, understanding what that looks like for them, and from them walking them through their journey, what the sell side process would look like for them, what the options may look like for them, and determining, okay, based on this business, here's what we think the market would bear, okay, and here's the pros and cons operationally within the business. And if we're going to market, here's where we're going to transact the business at more than likely. Or if we need to make a pivot to operational fractional CEO consulting, we can do that through that process. But in most cases, if we think the value is there, the client likes the value, we've identified a geographic presence of a strategic buyer in that market or a private equity buyer in that market, then we can say, hey, we have, based on your information, run a basic process and identified 6 buyers, 15 buyers in that market that I think would be a great fit for you. And here's how we think the process would work. It's a 6-month process, a 3-month process, a 9-month process, depending on the deal. We're going to run a sell-side QV, and here's how we think the numbers will fall through. Here's an economic waterfall for you. Here's how we think we're going to run it for you. And that's our sell-side discovery day process for them. And again, that's a different journey. And that client understands, okay, here's how my deal is going to look like more than likely. Again, every buyer is going to be different. Okay. Our recommendations of holdco equity versus JV equity, of how that's going to look like, if it's going to have distribution or no distribution. And if they were to do 20% rollover equity, 30% rollover equity, 40% equity roll, what that's going to look like in a deal structure. So we kind of map it out for them as they're engaging us for that discovery day. And so, it's a life decision, right? It's their life's work. So They get to kind of think about what that entire journey looks like over that 6 to 9 month or longer, depending on the EBITDA platform, what that looks like. Because, some of our clients are $5 to $9 million in EBITDA, and those deals are going to take, 9 months to 12 months long from start to finish, from engagement to actual completion in that process.
Sure. Well, both very different, but both sound like time well invested in the experiences that they are. And, like we covered, 2025 is a great time to go to market after the challenges of the years thankfully now passed. But there's also a lot to get in front of. And of course, Polaris is here to help support you. Well, Diwakar, thanks for joining me today. It was such a pleasure being back behind the mic with you. And I know our listeners want to hear from you on what's developing in the market.
Well, Jamie, thank you for having me.
Anytime. Well, we certainly appreciate your insights, and we look forward to more episodes with you as the year unfolds. Well, if you'd like to schedule some time to chat about taking your business to market or learn more about one of our discovery days that Diwakar talked about, please reach out to us at info@PolarisHealthcarePartners.com. As always, if you'd like to learn about any of our expert advisory services, or maybe there's a topic we haven't covered that you want to hear about, you can send us an email to that same address, info@PolarisHealthcarePartners.com, or you can always reach us by visiting our website, PolarisHealthcarePartners.com. Thanks so much for being a loyal listener and subscriber. If you enjoyed today's episode, please leave us a rating on Apple Podcasts, Spotify, iHeartRadio, or wherever you get your podcasts. We'll see you on the next episode of the Group Practice Accelerator Podcast.